The vaults are empty, the terrifying truth behind silver's price explosion. Welcome to a special in-depth analysis, where we dissect the tremors shaking the very foundations of our financial architecture. What happens when a cornerstone of the global industrial and monetary system reveals itself to be a phantom? This is not a story about market fluctuations or a simple commodity squeeze. It is a narrative about the unraveling of a decades-long deception, a crisis of tangibility in an increasingly intangible world. We are witnessing a seismic repricing, not just of a metal but of trust itself. The astonishing surge in the price of silver is merely the most visible symptom of a profound and systemic breakdown, a final, frantic reckoning between the paper promises of our financial markets and the hard, cold reality of the physical world. This is the story of how the illusion of supply evaporated, leaving a vacuum that threatens to pull the entire global financial order into its vortex, forcing a reset that will redefine the very meaning of wealth and money for generations to come. The prevailing economic condition of the last half-century has been an exercise in abstraction, a carefully constructed consensus that the symbols of wealth were interchangeable with wealth itself. In the precious metals market, this manifested as a vast and complex superstructure of paper contracts, derivatives, and financial instruments built upon a perilously small foundation of physical bullion. The London Bullion Market Association and the COMEX in New York evolved into the twin epicenters of this system, dictating the global price of gold and silver not through the auction of physical bars, but through the high-frequency trading of immense volumes of paper claims. This created an environment of perceived liquidity and abundance, where any demand, no matter how large, could seemingly be met with a corresponding supply of paper contracts. The system was predicated on a crucial, unspoken agreement that the vast majority of participants would never seek to convert their paper holdings into the actual underlying metal, content instead to settle their contracts in cash. This disconnect between the paper market and the physical reality created a profound market inefficiency, an opportunity for those who understood that the true value lay not in the fluctuating price on a screen, but in the finite supply of the metal itself. The system allowed for the creation of countless digital and paper claims for every single ounce of silver residing in the vaults. This practice, known as fractional reserve banking applied to precious metals, had the convenient side effect of suppressing prices. When demand for silver rose, it was met not with a scramble for scarce physical bars, which would send prices soaring, but with the instantaneous creation of new paper contracts, effectively diluting the demand signal and keeping a lid on the price. This artificial suppression served the interests of a financial system that benefits from stable commodity prices and a strong fiat currency, but it created a coiled spring of immense potential energy, waiting for the moment when physical demand would finally overwhelm the capacity of the paper charade. The catalyst for the disruption of this fragile equilibrium was not a single event, but a confluence of powerful global currents that began to erode the foundations of trust in the fiat financial system. Years of unprecedented monetary expansion by central banks, ostensibly to combat economic crises, had sown the seeds of persistent inflation, a slow but relentless corrosion of the purchasing power of currencies like the dollar. Simultaneously, a fracturing of the geopolitical landscape saw major powers actively seeking alternatives to the dollar-denominated trade system. Nations began to view their currency reserves not as assets, but as liabilities, and initiated a historic pivot toward tangible stores of value. Central banks, particularly in the East, began accumulating gold at a record pace, a clear signal that they were preparing for a new monetary reality where physical assets would once again reign supreme. This sovereign demand for real assets sent a powerful, albeit initially subtle, signal throughout the global markets. This growing unease among sovereign nations and institutional investors began to trickle down, awakening a dormant understanding among the public about the fundamental difference between ownership and entitlement. A grassroots movement, amplified by the digital age, began to advocate for the withdrawal of physical silver from the paper market system. This was not merely speculative fervor. It was a conscious and coordinated effort to expose the fractional reserve nature of the bullion banking system. Concurrently, the relentless and non-negotiable demand for physical silver from the industrial sector reached a critical inflection point. The global push toward green energy and electrification, from solar panels to electric vehicles, created a voracious and price-insensitive appetite for the metal. Unlike financial investors who can settle for cash, industrial users require the actual physical product to manufacture their goods. This created a powerful and unyielding new vector of demand that began to drain physical inventories at an accelerating rate, setting the stage for a catastrophic collision with the paper market. The tipping point arrived with a speed and ferocity that stunned even the most seasoned market observers. It began not with a bang, but with a subtle yet ominous signal from the deepest plumbing of the market: the sudden and dramatic inversion of the silver futures curve. The market flipped into a state of profound and persistent backwardation, where the price for immediate physical delivery of silver surged dramatically higher than the price for delivery in the future. This is an exceptionally rare and dangerous condition in any commodity market, as it signals a complete loss of faith in the promise of future delivery. It is the market screaming that it wants the real thing right now at any cost. This was the first clear sign that the dam of confidence was breaking, and that a torrent of physical demand was about to be unleashed upon a system that was never designed to handle it. What followed was a cascade failure of breathtaking proportions. The cost to borrow physical silver, reflected in the lease rates, exploded from negligible levels to annualized rates exceeding 100%. This was a death blow to the legion of traders who maintained large short positions in the paper market, as the cost to maintain those positions became ruinously expensive. The edifice of the paper market began to crumble as these leveraged players were forced to cover their shorts, not by buying offsetting paper contracts, but by desperately scrambling to find physical metal to deliver against their obligations. This set off a frantic global treasure hunt for any and every available ounce of physical silver. The price on the screen, the so-called spot price, began its historic ascent, blasting past its previous all-time highs with contemptuous ease, reaching $50, then $100, and then continuing to climb into the thousands, with the final quoted price of $5,355 an ounce becoming less a reflection of value and more a monument to the system's complete and utter breakdown. The epicenter of this financial earthquake was the London Bullion Market Association, the centuries-old heart of the global precious metals trade. The institution, once the very symbol of market stability, was thrown into a state of paralysis. The core function of the market, the daily settlement of billions of dollars in spot contracts with physical metal, ceased to operate. Major bullion banks, the gatekeepers of the system, found themselves in an impossible position, having sold countless claims on metal they did not possess and could not procure. The declaration of a failure to deliver by a single major member sent a shockwave of counterparty risk through the system, triggering a domino effect of defaults. Trading effectively ceased, not for lack of buyers, but for a complete and total absence of sellers willing to part with physical silver for any amount of fiat currency. The market had not just been ruptured, it had been revealed as a hollow shell. The immediate consequence of this catastrophic market failure was a violent and uncontrollable contagion that spread throughout the global financial system. The concept of counterparty risk, long dormant in an era of implicit central bank guarantees, roared back to life. Financial instruments and institutions that were built on the assumption of a functioning bullion market were rendered insolvent overnight. Exchange-traded funds, which had promised investors direct ownership of silver, were exposed as many held a mix of physical metal and paper claims, the latter of which were now worthless. The collapse of several major bullion banks, entities deeply intertwined with the entire global banking system, triggered a credit crisis that dwarfed previous financial meltdowns. The silver crisis demonstrated with brutal clarity that the web of financial obligations was far more interconnected and fragile than any regulator had ever admitted. The impact on the real physical economy was no less severe. The meteoric rise in the price of silver, and more importantly, its sheer unavailability, brought critical industries to a grinding halt. The much-vaunted green energy transition, heavily reliant on silver for the production of photovoltaic cells, was stopped dead in its tracks. The manufacturing of consumer electronics, medical devices, and advanced defense systems faced an existential crisis. This served as a harsh lesson to a world that had become complacent, a reminder that the digital and financial economies are ultimately downstream from the physical one. The crisis exposed the folly of allowing the price of a strategic and irreplaceable industrial metal to be dictated by a leveraged paper casino. The global supply chain, already fragile, began to buckle under the weight of this critical material shortage. This breakdown of trust in financial instruments and paper promises triggered a profound psychological shift in the collective consciousness. The public, witnessing the evaporation of paper wealth, initiated a mass exodus from financial assets into tangible ones. This was not just a flight to safety, it was a flight to reality. The demand for physical gold surged in tandem with silver, as individuals and institutions alike sought refuge in the timeless monetary metals. Gold shattered its own price records, climbing to over $4,200 an ounce, not merely as a reaction to fear, but as a rational repricing of value in a world where the primary unit of account, the dollar, was rapidly losing its credibility. This mass movement into tangible assets extended beyond precious metals, igniting a boom in real estate, agricultural land, and any physical commodity that could not be printed or deleted. The long-term significance of this great unraveling is the forced initiation of a global monetary reset. The catastrophic failure in the silver market was the catalyst that laid bare the fatal flaws of the post-Bretton Woods fiat currency system. A system built on ever-expanding debt and anchored by nothing more than confidence had finally reached its mathematical and psychological limits. The crisis demonstrated that the United States dollar, stripped of its tangible backing and used as a tool of geopolitical influence, could no longer serve as the stable foundation for global trade and finance. The end of its reign as the world's sole reserve currency was no longer a matter of academic debate. It had become an operational necessity for the survival of the global economy. The world was forced, by the sheer logic of events, to begin the arduous process of building a new monetary order. The enduring lesson from this historic crisis is the rediscovery of the fundamental principles of money and value. It serves as a stark reminder that wealth is not an abstract number on a digital ledger, but a claim on real-world resources and human labor. The crisis exposed the hubris of a financial system that believed it could create prosperity through the printing press and defy the laws of supply and demand through financial engineering. The new financial landscape that will emerge from the ashes of the old will inevitably be one that is more firmly anchored to the physical world. Whether this takes the form of a renewed gold standard, a basket of commodity-backed currencies, or a hybrid system incorporating digital technologies with physical asset backing, the core principle will be the same. To restore trust, you must restore tangibility. The future will be defined by this paradigm shift, a great rebalancing between the financial and the real. The transition will undoubtedly be turbulent, marked by economic dislocation and a reordering of the global balance of power. Nations with significant holdings of tangible assets, from monetary metals to energy reserves and industrial capacity, will find themselves in a position of strength. Conversely, those economies that relied heavily on financialization and the export of their currency will face a painful period of adjustment. The crisis serves as a powerful forcing function, accelerating a multipolar world where economic power is more widely distributed and based on productive capacity rather than the privilege of printing the reserve currency. It marks the end of an era of financial dominance and the beginning of a new one defined by real-world value. Individuals navigating this new landscape must internalize the core lesson of the silver crisis: the importance of holding a portion of one's wealth outside of the conventional financial system. The distinction between paper promises and physical possession has been irrevocably etched into the minds of a generation. True diversification is not about holding a variety of different paper assets, but about holding different forms of wealth, including those that carry no counterparty risk and cannot be devalued by the stroke of a central banker's keyboard. Physical gold and silver for millennia have served this exact function. They are not investments in the traditional sense. They are insurance against the failure of the financial system itself. Their ultimate value is not measured in a fluctuating fiat price, but in their enduring ability to preserve purchasing power across the tides of history and through the collapse of empires and their currencies. The process of rebuilding the global monetary system will be a monumental undertaking, requiring unprecedented international cooperation. The alternative, a descent into currency wars, protectionism, and economic chaos, is too dire to contemplate. The reset will likely involve a revaluation of all assets against a new, more stable anchor. Gold, due to its historical role and its status as a neutral reserve asset held by central banks worldwide, is the most logical candidate to serve as the ultimate arbiter of value in this new system. The immense outstanding debts and financial obligations of the current system will need to be restructured, a painful but necessary process of acknowledging past excesses and building a more sustainable foundation for future growth. This is not merely a financial reset. It is a societal one, a chance to recalibrate our economic priorities away from speculation and toward productive investment. The narrative of the silver crisis is therefore not one of doom, but one of transformation. It is the painful but cleansing process of a system shedding its own internal contradictions. It forces a return to first principles, reminding us that economies are not built on complex algorithms and derivative contracts, but on the production of real goods and services. The future of wealth will belong to those who understand this fundamental truth, those who can distinguish between the fleeting illusions of the paper markets and the enduring value of tangible, productive assets. The shock of the silver market's collapse serves as the ultimate wake-up call, a final opportunity to prepare for a world where the rules of the game are about to be rewritten, and where true security lies not in the promises of others, but in the assets you can hold in your own hand. The architecture of our global financial system, meticulously crafted over the past 5 decades, was built upon a foundation of sand. This system, detached from any tangible anchor, relied on a complex interplay of confidence, mathematical models, and the perceived omnipotence of central banks. It fostered an environment where debt could be endlessly expanded, and where financial instruments of bewildering complexity proliferated. The illusion was one of sophistication and resilience, yet its core vulnerability was its complete dependence on human belief. The precious metals market, particularly silver, became the Achilles heel of this construct. It was one of the few remaining arenas where the abstract world of finance was still tethered, however tenuously, to the concrete world of physical atoms. The final, desperate scramble for physical silver was the moment that tether snapped, revealing the system's inherent fragility. The problem was not a lack of silver in the Earth's crust, but a catastrophic shortage of deliverable investment-grade bullion within the financial system's circulatory network. The vaults of the LBMA and COMEX, which were supposed to act as the ultimate backstop for the market, were exposed as containing only a small fraction of the metal that had been promised and sold many times over. This deficit was the system's dark secret, a truth obscured by opaque reporting and the tacit agreement among major players to maintain the facade. The relentless drain from industrial demand, coupled with the sudden surge in investment demand for physical delivery, created a vortex from which there was no escape. The system had promised a liquidity that was purely fictional, and when the bluff was called, it had no cards left to play. This wasn't a black swan event. It was the inevitable outcome of a system designed for collapse. The catalytic force was the decentralization of information. In previous eras, the arcane workings of the bullion markets were the exclusive domain of a small cabal of bankers and traders. However, in the 21st century, knowledge of the paper market's fractional reserve nature spread like wildfire across the globe. Independent analysts and citizen journalists dissected vault reports, tracked physical flows, and educated a global audience on the difference between an unallocated account and a physical bar in hand. This democratization of knowledge empowered millions of individuals to act in their own self-interest, bypassing the traditional financial gatekeepers and opting for direct ownership of the physical metal. This global, decentralized run on the bank was a force that the centralized paper market was powerless to stop, as it could not be controlled or co-opted by the usual institutional levers of power. The tipping point can be traced to the moment the arbitrage mechanism between major trading hubs failed. In a functioning market, significant price discrepancies, such as those that appeared between London, New York, and Shanghai, would be quickly closed by traders shipping metal to the higher-priced location. However, the breakdown occurred when there was simply no metal available to ship. The price divergence became a chasm, a clear signal that these were no longer connected components of a single global market, but disparate, isolated islands of demand. The astronomical lease rates and the deeply entrenched backwardation were the mathematical proof of this physical fragmentation. It was the definitive moment when the concept of a single global spot price for silver became a meaningless fiction. There was only the price you could get if you were lucky enough to find someone willing to sell the real thing. The aftermath of this collapse will be studied by economic historians for centuries. It marked the end of the era of pure financialization. The crisis forced a painful but necessary reevaluation of how we price assets and measure value. The survivors of the reset were not those with the most complex trading algorithms or the largest portfolios of digital assets, but those who held unencumbered title to tangible things. This included not only precious metals but also productive land, energy resources, and profitable, well-run businesses that provide essential goods and services. The crisis acted as a great filter, separating illusory wealth from real wealth. It taught a harsh lesson that in times of systemic crisis, the value of an asset is directly proportional to its lack of counterparty risk. The ultimate takeaway from this monumental event is that a sound monetary system is a prerequisite for a stable and prosperous society. The experiment with a purely abstract debt-based fiat currency system, while enabling a period of unprecedented credit expansion, ultimately proved to be self-destructing. The new system that will be born from this crisis must incorporate the hard-won lessons of the past. It must have a mechanism that imposes discipline on governments and central banks, preventing the debasement of the currency through excessive printing. It must be anchored in a way that fosters long-term savings and investment over short-term speculation. The reintroduction of a tangible asset like gold into the core of the monetary system is not a step backward, but a necessary step forward, a way to rebuild the foundations of trust upon which all economic activity depends. The future global economy will be fundamentally reshaped by this reset. Trade relationships will be reconfigured, with bilateral agreements likely being settled in currencies backed by tangible assets rather than a single dominant fiat currency. This will foster a more balanced and equitable global trade environment, reducing the exorbitant privilege enjoyed by the issuer of the reserve currency. The power to create money out of thin air, which has been the exclusive domain of central banks, will be curtailed. The value of money will once again be determined not by committee, but by the immutable laws of supply and demand for the underlying assets that back it. This will usher in an era of greater price stability and encourage a more prudent allocation of capital toward productive enterprises rather than financial speculation. For the individual, the path forward requires a new level of financial literacy and personal responsibility. The age of passively entrusting one's entire wealth to a system of opaque financial intermediaries is over. The new era demands an active and educated approach to wealth preservation. This means understanding the risks inherent in any asset that is simultaneously someone else's liability. It means diversifying into assets that can weather the storms of financial resets and currency devaluations. The crisis has provided a clear blueprint for this new approach. Prioritize the ownership of real, tangible assets that have a long history of preserving value and possess an intrinsic utility that is not dependent on the stability of the financial system. The dysfunction in the silver market was a microcosm of a larger systemic issue, the complete financialization of the real economy. For decades, the goal was not to produce better goods, but to create more clever financial products. We sliced and diced mortgages, we created derivatives on top of derivatives, and we built a global economy that looked more like a casino than a workshop. Silver, a humble industrial metal, became the unlikely battleground where this philosophy finally met its demise. The insatiable demand from industries building the future, a demand that could not be satisfied with a cash settlement or a digital entry, collided with a market that had forgotten its physical purpose. The resulting explosion was the sound of reality reasserting itself over financial fantasy. This crisis was not unforeseen. For years, a chorus of dissenting voices from the margins of the financial world had warned of this exact outcome. They pointed to the impossibly high leverage ratios in the paper markets, the steady depletion of visible physical inventories, and the growing geopolitical tensions that were driving nations to seek monetary alternatives. These warnings were largely ignored by the mainstream financial media and the political establishment, who dismissed them as the paranoid ramblings of doomsayers. The system was too big, too sophisticated, and too profitable to fail. The collapse of the silver market stands as a testament to the dangers of this institutional arrogance and the catastrophic price of ignoring inconvenient truths until it is too late. The next chapter in our economic history will be written by those who can adapt to this new reality. The reset will create a new set of winners and losers. The losers will be those who remain wedded to the old paradigm, clinging to the belief that paper assets and fiat currencies can provide long-term security. The winners will be those who understand the shift that has occurred and position themselves accordingly. This means prioritizing resilience over returns, tangibility over abstraction, and solvency over leverage. It means thinking like a central bank, which holds gold not for speculative gain, but as a permanent, strategic asset to ensure its survival through any crisis. The strategies that worked in the age of financialization will be the very strategies that fail in the age of repricing. The lesson transcends finance and touches upon a more profound philosophical point about the nature of modern society. We built a world on promises, a complex web of trust in institutions, governments, and the digital systems that underpin our lives. The silver crisis represents the moment that trust was irrevocably broken in a key pillar of that world. Its failure sends a warning signal to all other aspects of our interconnected society. It forces us to ask difficult questions about the true resilience of our food supply chains, our energy grids, and our digital infrastructure. The Great Silver Squeeze was a stress test that the financial system failed in spectacular fashion, and it should compel us to examine the other potential points of failure in the complex systems upon which our civilization depends. Ultimately, the path to a more stable and prosperous future lies in embracing the principles that the silver crisis has so brutally taught us. We must rebuild our economic and financial systems on a foundation of transparency, accountability, and a healthy respect for the physical limits of the real world. We must foster a culture that values long-term productive investment over short-term speculative gambling. We must empower individuals with the knowledge and the tools to achieve true financial sovereignty, freeing them from a dependence on a fragile and often self-serving system. The crisis in the silver market, as painful as it has been, may ultimately be remembered as the necessary catalyst that forced humanity to abandon a destructive path and begin the difficult but essential work of building a more resilient and equitable world. The final panic surge to over $5,000 an ounce was not an auction, it was a surrender. It was the price the paper market was forced to offer in a futile attempt to coax physical metal out of the hands of those who no longer believed in the paper itself. But the offer was rejected. At that point, the holders of real, physical silver understood that they possessed something far more valuable than a pile of rapidly depreciating fiat currency. They held a strategic industrial asset in a world starved of it. They held a timeless monetary metal in a world questioning the very definition of money. They held, in essence, a lifeboat during a flood, and no amount of paper currency could persuade them to give it up. This refusal to sell at any price was the final verdict on the fiat system, the moment the market declared that the emperor truly had no clothes. What the world is now grappling with is the monumental task of price discovery in the absence of a functioning market. If the London and New York paper exchanges can no longer set a credible price for silver or for gold, then what is the true value of anything? This is the core of the crisis. The failure of the bullion markets is a failure of the entire global pricing mechanism for all commodities and assets. It reveals that the prices we have taken for granted were not necessarily a reflection of true supply and demand, but rather the output of a heavily financialized and manipulated system. The world is now entering a period of profound uncertainty, a fog of value where the price of everything is in question. This is the chaotic, but necessary first stage of a global repricing, where market forces, raw and untamed, will seek to find a new equilibrium based on tangible value rather than financial abstraction.